Making bad investment decisions during bad times can cost you. Hello, and thanks for checking us out on this week's Fastest 4 Minutes in Finance. I'm Scott Inman. A new study from Morningstar was released last week that finds the average fund outperformed the average investor over the past 10 years by 1.7% per year. The average fund gained about 7.7% a year from 2012 through 2022, and the average dollar invested in those funds earned 6% per year. Now, that may not sound like a big difference, but over 10 years, that's a 17% difference. The Mind the Gap study compared the average investor's return on investments in funds and exchange-traded funds and compared it with the average fund's actual total return. The difference, or the gap, is attributed to the timing of when investors bought or sold shares. It speaks to what we say all the time. It's not about timing the market, but time in the market. Some investors are trying to time the market, and some are not, but they may still be. For instance, for some investors, timing the market is straightforward. They're trying to pick a good time to get in when they believe the market has reached a bottom, and they try to pick a good time to get out when they believe the market has reached a peak. But for most investors, the timing occurs more subconsciously. Most investors tend to buy more when funds are performing well and sell when funds are performing poorly. For instance, the stock market, as measured by the S&P 500 index, was down 19.4% in 2022. At various points along the way, many investors grew weary of watching their account values go down and either partially sold out or maybe even got completely out of stocks. Through the first 7 months of 2023, the S&P 500 index has surged about 20%. Many investors may have bought back in by now, but at what point did they do that? If they sold on the way down and bought somewhere on the way back up, they created their performance gap. This is behavioral finance, and it's one of the areas where a financial advisor can help. It is extremely difficult for an investor to be objective about their own money. An advisor should bring objectivity to the relationship and help investors avoid making the wrong decisions based on emotion. At the same time, investors who are getting close to retirement shouldn't be 100% in the stock market in the first place. That's another place where an advisor can provide help. If you have 20 years until retirement, the ups and downs of the market may not rattle you. After all, it's only a number on a page until you decide to sell. But near retirement, you may be close to selling at least some of your assets to create retirement income. You don't want to be forced into selling stock when the market is down. A written income plan and a diversified investment strategy should include a way to take the volatility out of the near term and provide an investor with the ability to satisfy their income needs over the course of their entire retirement. That produces an entirely different kind of emotion, one that relies on planning rather than performance. Thanks for watching.